What is the difference between regular dividends and qualified dividends? Have you ever wondered why some dividends seem to come with a lighter tax burden? Today, we will break down the differences between regular dividends and qualified dividends, especially in the context of tax planning and tax-advantaged investments. Regular dividends, often referred to as ordinary dividends, are payments made by companies to their shareholders from their earnings. When you receive these dividends, they are taxed as ordinary income. This means they are subject to your regular tax rate, which can be as high as 37%. This can lead to a heavier tax load compared to other income types. On the flip side, we have qualified dividends. These are a special category of dividends that meet specific criteria set by tax authorities. The key benefit of qualified dividends is their favorable tax treatment. They are taxed at long-term capital gains tax rates, which currently range from 0% to 20%, depending on your income level. This lower rate is designed to encourage long-term investments in stocks. To qualify for this special tax treatment, dividends must meet certain conditions. First, they must be paid by a United States corporation or a qualified foreign corporation, typically one that is traded on a United States stock exchange. Second, you need to hold the stock for a minimum period. For common stock, you must hold it for more than 60 days during the 121-day period, starting 60 days before the ex-dividend date. For preferred stock, the holding period is more than 90 days during the 181-day period, starting 90 days before the ex-dividend date. Additionally, the shares cannot be hedged during the holding period. This means you cannot use options or short sales on those shares while holding them. Understanding the difference between regular and qualified dividends is essential for effective tax planning. Banks and credit unions often provide investment products that pay dividends, such as mutual funds or brokerage services. The tax treatment of these dividends can significantly impact the overall return for clients. Encouraging clients to invest in dividend-paying stocks that yield qualified dividends can be a smart tax-efficient strategy. It helps reduce their tax liability on dividend income. However, it is important to clarify that dividends paid on bank deposits, like interest on savings accounts or certificates of deposit, are not considered qualified dividends. These are taxed as ordinary income. In summary, the main difference lies in how these dividends are taxed. Regular dividends face your ordinary income tax rate, while qualified dividends benefit from lower capital gains tax rates, provided you meet specific holding period and issuer criteria. This distinction is vital for anyone looking to optimize their tax planning and investment strategies.